welcome back to the programme. Tonight we're joined by Wendy Priestley from the Investors Club and Aaron Greaves from Omniwealth. If you've got a question about what types of property you should be buying and how you can retire on property, then give us a call on 1300 30 34 35 or send us an email to property@skynews.com.au. And now it's time for our new segment of Viewer Tip of the Week. And this week's tip comes from Fred Hollister, who's actually got 3 tips in one. And Fred says, buy for positive cash flow. Appreciation is nice, but monthly net income pays the bills. Profits are generally made when properties are purchased, not when they are sold. So buy at the price that produces the return you seek. Now, you don't have to worry about purchasing at the bottom of the market because he believes that's for single-family home investors and speculators. Now, tenants pay the rent, so you need to be sure the tenants are stable, able to pay the landlord each month, and are going to stick around for a while. Now, to get your tip of the show, simply email me at property@skynews.com.au, putting Chris Gray in the subject line. Now, all tips that we show will receive a signed copy of my book, The Effortless Empire, so please ensure that you include your mailing address. You can also download a copy for free at yourempire.com.au. Now, Wendy, this really starts another great debate. Fred there was talking about positive cash flow. Tell us maybe what you believe is the difference between a strategy for positive cash flow and maybe for capital gain, and maybe some of the pros and cons.
Well, in my personal experience, looking at buying cheaper property for positive cash flow can be positively dangerous because it doesn't actually take into account the age of the property and the level of maintenance, and sometimes those items can really kill you. We have one property in our portfolio of 25 properties that is of this type, and it is older, it has good cash flow, or it has a positive cash flow. But over the years, it hasn't grown in value and it hasn't grown in the rental, and the repairs to the property have been expensive, and yet buying newer in the beginning, negative cash flow. So I think, again, this is the difference between a short-term and a long-term focus. A business person doesn't necessarily go out and buy the cheapest or something that gives a small cash flow. They're looking to make a long-term investment and then seeing that they can contribute some money as an investment into their business, and then they'll get value and returns further down.
Because obviously one of the advantages of positive cash flow is if it's actually putting money in your in your pocket, then the banks are actually going to like it.
Well, I think we need to look at how much money is really being put in your pocket, and usually, in my experience, the information I've seen on positive cash flow, they're putting, $20 or $100 a week. Well, how many people want to live on, that amount per week? Because
if it's not growing, then it's hard to pull the equity out.
Absolutely.
To carry on repeating.
Yeah.
Yeah. Now, another tip on there, Aaron, was people saying you profit when you buy.
Yep.
When you're investing for the long term, is that necessarily true, or is it about getting more of the right asset?
Look, I think if you look back over 20 years, or if you're in the future and 20 years back, the $50,000 that you may getting in at the bottom of the market, you're not going to notice it. Where it does play an important role, though, is if you want to build a property portfolio and you need to buy your second and third property. In that case, it is important for you to identify a market that is more beneficial to get into, somewhere near the bottom, so that in 2 or 3 years, you have developed some equity to move on to your next one.
Sure. And when it comes to tenants, how important is it to get the right kind of tenants?
Obviously, it's important, but it's funny, in all the years I've been doing this and all the clients and the hundreds of properties that we have, I've never experienced a bad tenant out of all of that. I think the fear of getting a bad tenant is far more than the reality of getting one.
And a lot of people say, oh, I haven't put the rent up because I've got good tenants. But if you've got a good property, you should be getting good tenants all the time.
Yeah.
The swing should be the other way. Obviously, the Investors Club, you span all around Australia. Have you got some horror tenant stories?
Absolutely. Just recently speaking with 3 of our members around Australia, and the tenants, we'd have to say inadvertently, burnt a house down. Now, if you have perhaps the concept that you don't want to get a bad tenant and they're burning the house down, then if you've got the right insurance, sometimes a bad tenant can be a good tenant. You've got a landlord's insurance, you get the property refurbished, and you've got new depreciation. So sometimes, a good tenant can turn a bad tenant overnight. Family disputes, employment circumstances. I think what property investors need to do is look on how they mitigate those risk and cover that risk, and that would be appropriate insurance.
Because we actually covered insurance a couple of weeks ago on the show, and for a lot of tenants, even though a tenant's in your property and they might burn it down, a lot of them aren't insured. So you've really got to make sure that you've got the insurance, don't you?
Absolutely, but tenants need to cover their own insurance, but you need to cover both your property and your income stream.
Yeah. Now, you talked earlier on about only a certain percentage of people have only got one investment property and not many people go on to two or more. Why is that, do you think?
Well, for the reasons that have been published in ABS information, where you've got people sell because it's so difficult to finance, they say. A lot of those times are because they're with the one bank and they find it difficult. The bank has a view that they can't handle any more property, and other times are that they're thinking that they need to sell a property to get funds out to do other things with it instead of understanding the finance structure. Managing a property becomes a headache because often they're on their own, they're not with a support group, they don't know, sometimes they might manage it themselves, they don't know tenancy laws. You know, they're trying to do it all themselves as a hobby, and it gets too hard and I'll just give it away.
And that's why they really need to get the education to find out the real pros and cons.
Yeah.
Because a lot of people say tenants, it's an absolute nightmare dealing with a tenant, but if you get the right property manager, there's no reason why it should be.
Yeah.
Yep. Now we'll jump to the phone lines to start with, and we've got a young lady, I think, from Perth. Hello.
Yes, hello.
Hi, how are you?
Yes, hello. Thank you for taking my call.
Sorry, I didn't catch your name before.
Yeah, the reason I'm ringing is the house that we're living in here in Perth, it's mortgage-free. We haven't got a mortgage, and it's a $600,000 property, and we're on the verge of just buying our second investment home. The first one is in Queensland, and it's doing very well. We've got lovely tenants in there. Now, the second home we're thinking of buying. Now, what we're thinking of, whether to start paying off the second investment property or leave the money in the offset account, any savings that we do have.
Right, okay, so you've got a family house that's all paid off.
Yes.
You've got a second investment that's got some debt on it, and you want to work out, well, should you be paying off that second investment debt or just putting it into the next property?
Yes, or to leave the money in the offset account. What would be the best option?
Right, okay, I'll jump to you to start with, Aaron.
Yep, fundamentally creating wealth is about the size of your asset base. So the more assets you have working for you, the more wealth you'll have into the future. So if you have an option today to buy another asset or another property that can help create wealth for you, that is going to be far, far better for you than trying to pay down debt at the moment.
Okay, Wendy, any thoughts?
Yes, certainly agree with that. The other perspective is that you have no tax deduction for paying down a principal. So instead of spending your money paying down a debt, use it to increase the size of your asset base, as Aaron said.
Yeah, and look, I'd say exactly the same thing. At least if you are going to pay money off, then put it into the offset account rather than paying down the debt, because then when you take it back out again, then all of the debt's tax deductible. So sounds as if you're doing the right thing. Now we'll jump to Richard. Welcome to the show, Richard.
Good evening. How you going?
Very good, thanks.
For
What's your
taking
question?
my call. I'm just inquiring. I've got a block of land that I want to subdivide. I want to put 4 units on there, and I want to subdivide into obviously 4 either community title or Torrens title. I was wondering, I'm planning on keeping the units for at least 5 years. Do you think community title is actually a lot cheaper than Torrens? Do you think there's a big difference in the final price I'll get or the rent along the way?
Right, okay. Wendy, do you know anything about Torrens title or community title and the differences?
Torrens title is where you own the block of land and the outside of the building itself, and the community title is one word for strata title around different states, and that's where you have a community owning the outside and maintaining it. From a perspective of investing and owning, some people think that strata is too expensive, but they don't realise that in the strata cost you're actually putting into the sinking fund like a savings account to repair and maintain the property. When you own a Torrens title, it actually means that often people don't put aside money for repairs and maintenance, so sometimes there's some false economy from depending if you have a strata and you have someone maintaining the grounds. Tenants prefer that. managing a Torrens title is requiring the tenants to mow and keep the lawns and the gardens and whatever. So, you know, there's pluses and minuses on both sides, but personal preference, I would go both as an owner and as a tenant for strata property.
Okay. Aaron, any preferences from you?
No, your success in that property is going to come down to supply and demand, both from a rental perspective and from a capital growth perspective.
Yeah, Richard, my suggestion is it may depend on the area. I think similar to Wendy, there would be pros and cons of both. Some people hate strata, they think they can't get anything done, whereas other passive investors, then they think, oh look, I can walk away, I can go overseas and not worry about it, someone else will look after it. So maybe two people to ask, if you're looking at reselling later on, is speak to the local agents in the area and see what they have to say, and certainly speak to the bank or a valuer to see if they would put a different price on things. Because certainly around Sydney we have a lot of company title and people don't really like those and the bank doesn't like them. But between Torrens and strata title, not too sure. So definitely check in the local area. But thanks for the call. Now, we were talking before about people owning multiple properties. I guess from your side as well, Aaron, you're seeing a lot of people, you're seeing a lot of different wide ranges of ages and male and female. Are there certain characteristics of people that go for big portfolios and other ones that just can't get over the fear barrier?
Yes and no. It all comes down to education, ultimately. We're creatures of habit, and what we find within our business is people will typically try to invest the way their parents invested at the start. What we then do is take them through an education process to tell them that there are other ways of doing things. When people focus on, at some point in the future, being financially independent, they soon realise that they're going to have to own multiple properties. And their desire to achieve that financial independence will help them take that next step.
Yep. Now, Wendy, you brought along some financing tips, which we'll put up on the screen in a second. And your first one you mentioned was use different banks. Why do you recommend that?
Absolutely, because in our experience, just because you have people lending you money doesn't mean to say that they know how to assist you creating wealth. And so what the banks are interested in is tying up all your assets, which means that they will reduce your borrowing capacity in terms of how they assess your risk to them. So by having multiple banks, you can increase your purchasing capacity and therefore building a larger asset base.
Right, okay. And then some of the other tips on that?
Well, diversify for rental growth, as we spoke before, buying around different areas of Australia so that ones that are having a high rental growth can compensate rather than having all your eggs in one basket and being more or less sometimes in the same postcode as yourself. Always, as a good landlord, you want to move the rental up not only in line with the current trends, but keep your property up there on high desirability by tenants, making improvements, keeping it painted, new carpets, air conditioning, fans, pergolas perhaps, making improvements so that you're always improving your rental return.
And the classic other ones you had there was kind of reducing personal debt and credit card limits. Are they kind of no-nos for the bank?
Absolutely. The banks look at your personal debt, your credit cards, not by the amount that you pay off each week, but by your limit. So, you know, if you've got a $10,000 card, but you only use $2,000, then that excess of $8,000 is not serving you a purpose and can reduce your borrowing capacity significantly.
Because they'll actually assume that they'll take the full limit kind of the next day. And also salary sacrificing, that's a good one as well, because a lot of people think, oh, that's working more tax efficiently, but for lending it's actually working against them, isn't it?
Absolutely. The bank is looking at what your bottom salary is. So if you're on $100,000 and then you salary sacrifice $20,000 for various things, you've just lost $20,000 of borrowing capacity. So use your properties to reduce your taxable income if that was the reason for salary sacrifice.
Some very good tips there. Joining me on the panel of experts tonight is Wendy Priestley from the Investors Club and Aaron Greaves from OmniWealth. If you've got a question or want to join the discussion, number to call 1300 30 34 35 or send us an email to property@skynews.com.au. We'll be back in just a minute.